Hi, everyone. It's John Pocoroba. I thought it'd be nice to do a general market update here at the beginning of the 22 year. So I wanted to take you through, spend more time today on the big picture for stocks, where we are, and take you through my thoughts on the current market. So as I always do, I'm going to start with the big picture of the market. And I always start with this very, very big picture, which is I use this example of the super cycle from 1974 through 2000, a 26-year super bull market. And the driver of that was really in the early 80s. The baby boomers were a large generation that entered peak consumption years. And for a long period of time, over 16 years, they drove a lot of economic activity. And I compare that to what I believe is the super cycle that we're currently in. And that super cycle started with the 2009 bear market bottom. And the real catalyst has kicked in the 2018-2019 timeframe. We have 84 million millennials entering peak consumption years. The oldest millennials turned 40 here in 2021. And so it really sets us up for a 15-year window, as I've shown in green, of 15 years of really peak consumption, where millennials as a generation are buying houses, cars, insurance, financial services. At the same time, many boomers are retiring, buying second homes, and transferring wealth to the millennials. So what's important about a super cycle is to recognize that there still will be bear markets and setbacks and corrections along the way within a super cycle. We've already had the 2018 bear market, the 2020 COVID bear market, and we're certainly late in the market cycle right now. I thought it would be good to show this diagram, because this diagram shows the blue overlay is the stock market cycle, and the yellow overlay is the economic cycle. And the stock market cycle is always a leading indicator. It always looks 6 to 9 months in advance of the economic cycle. So you can see this blue wave, early bull market, middle of a bull market, and late bull market. The market tends to peak out much earlier than the actual peak in economic activity, the economic cycle. I've drawn a red arrow where I think I would approximate where we are right now in the stock market cycle. We're in the late stages of the market. And you'll notice that groups 6, 9, and 11, which happen to be basic industry, energy stocks, and precious metals, are usually the cyclical stocks lead late in the market cycle. And that's where I believe we are today. So when we look at how markets top, I've shown here the 2007 market topping process, and I've looked at this by market capitalization. What typically happens when a market tops is the most risky and speculative types of stocks, which would be the micro cap stocks, the small cap stocks, the IPOs, which are all really speculative and risk on investments. Those tend to peak way before the entire market will peak. And in the 2007 cycle, you can see here the purple line, micro caps peaked out, small caps peaked out, then the mid caps, and they really started their downtrends. While the main market averages, such as the NASDAQ, the QQQs, and large cap growth stocks, were still advancing. As you can see, it wasn't to the very end of the market top in late 2007 that the big caps actually topped out. In this case, there was 3 to 4 months in advance of the actual top of the market. So if I were to translate that to today's picture, a very similar thing is going on, because it's typical. You'll notice here that this very light purple line of the IPOs. The IPOs topped out in February of this past year, a year ago, 11 months behind us. Also, the number one group in the market, which was enterprise software group, it topped out as well during the February timeframe. This purple line you can see has been deteriorating for months, and you see software has been making new lows for almost 6 months straight. And even today in the market was a bad day for software. Now, small caps peaked out in March. They basically went sideways, represented by this red line. And I've drawn a line where they tried to break out in early November, and it looked like things were really improving, but they got turned away and the breakout failed. And you can see in the black line here, this is the NASDAQ composite. The NASDAQ composite is still attempting to make new highs. It's been struggling a bit. It's not the leading index anymore, but these large caps, if they get turned away, the whole index may roll over. Now, the number one ETF out there right now is in technology is the semiconductor space. And you'll notice that the semiconductor line is still making new highs. So this is really the last ETF within technology that's still working. Now, growth stocks will top out one by one. And what you typically see at the top of a bull market, when the bull market's about to roll over, typically growth leading stocks, you'll see about 1/3 of those stocks peak before the actual market averages peak. Then you'll see 1/3 of the stocks peak probably about the same time as the market averages are starting to roll over. And then about the other third will happen once the averages have actually turned down. This slide is representing, these are all the big winning growth stocks of the past 18 months. And you can see these are the high price watermarks for these stocks, leading up to the end of last year. So you can see that this is a good big group of winners has already peaked out. And interesting, the market was still advancing while you're starting to see the deterioration in growth stocks. So this time frame is really an interesting time frame in the sense that I remember back in the fall of 2018, the bull market had been running for a bit, and we ran into some trouble in September, October of 2018. And I learned some real interesting lessons of how I was operating within a late market cycle. And I thought that I would share those lessons with you today because I do think some of them can translate to maybe what you're going through, whether you're a new trader or even if you're an experienced trader. And I'm speaking to these lessons relative to myself, which is really a position trader. If you're a day trader or swing trader, you might not relate to all of these, but as a position trader, I wanted to share what I've learned from the past market cycle. So in 2018, we had a nice 2017, the market was going well, and we had a pullback. And I was determined to get back into the market on any strength I saw and any follow-through day. I was very anxious to get back into the market. And as a result of that, got very chopped up in the final quarter of 2018. Took a lot of little paper cuts, and it really eroded gains for the year. And I actually spoke about this in the Boston meetup in 2019 at a presentation called Losing Streaks. So if you're interested, go look for that. But here's the first real lesson I learned about operating in a late market cycle. Don't buy late in the cycle. Reason being is the odds are increasingly against you. Simply put, there are fewer and fewer stocks that are participating in the rally attempts. There's less new highs. And it becomes very difficult late in the market cycle to really determine when are you buying too late, when are you buying late, and then when is it too late. The second major lesson I learned in the 2018 cycle was market tops take time. They are a process. Market tops are a process where the trend is actually going through change. And you'll see rotation to cyclical stocks and or defensive names. As I mentioned, fewer stocks are making new highs at this point in the market. And it's hard to recognize, but you have to think about it and say, I may be buying early in a bear market versus actually buying after a correction. So it's a little tricky, but you really want to watch any rally attempts late in the market cycle. You want to look at the volume, you want to look at breadth, and you want to look at the leadership. Is the leadership still strong? And we'll talk about this a little more in this video. And the last thing that I learned was really a psychological, I'm sorry, the slide is a little out of order. It's a psychological issue. When you have, if you are in cash, or you primarily have most of your money in cash right now, there's a couple of things psychologically that you have to deal with. One is sold out bulls, which means if you were really bullish the past 18 months and you've gone to cash, you're a sold out bull, you're really the textbook definition of impatient. And the reason you get very impatient is because you've gone to cash and you literally have too much money burning a hole in your pocket. You have an account that's in cash and you want to put it to work, but the market conditions are not right. And you might say to yourself, oh, I can afford a little loss here and there, so I'm going to dabble and try some positions. I would advise you, because the lesson I learned was really focus on protecting what you've earned. There's no need to follow all the action everywhere when the odds are clearly stacked against you late in the market cycle. So I want to, even though we may be near a peak in the market, you know, the long-term picture is still strong. I mentioned the super cycle, and also this is a monthly chart of the NASDAQ. You know, the market, the NASDAQ could come back down all the way down to the 11,000 area, which would be about a 30% correction. And we would still be in the super cycle I described at the beginning of the video. So we've come a long way. A correction would not be so bad to have. We'll have to see how this plays out or if the market regathers itself. Let's look at a few of the internals. This is the New York Stock Exchange advanced decline line. Very simple message in this chart. The top of the chart shows the S&P 500, and you can see the S&P 500 has been making new highs for the past 2 weeks. You'll notice that the number of advancing decline, advancers versus decline, has been eroded terribly over the last 6 weeks. And as the S&P is making new highs, we're getting a divergence. You want to see the advanced decline line hit new highs at the same time that the index is hitting new highs. We have a divergence. It's called a negative divergence, and it basically means fewer stocks are making new highs, which means there are lower odds that you're going to buy a stock that potentially could make new highs. Here's another type of divergence. The black line is the S&P 500. As you can see, it's starting to make new highs. But two other interest-sensitive groupings, the broker-dealers ETF and the financials ETF, have been struggling. Both peaked out in late October, early November. And you can see the gray line is the broker-dealers, which are nowhere near confirming a new high. The financials have improved a little bit, but they're not at new highs yet to confirm the new highs we're seeing in the S&P. Also, you'll notice that the last significant new high in the S&P had a net new highs of 266. Last week, we had net new highs of only 109. That is also a negative divergence in the leadership of the S&P 500. Today, I took a look, and the S&P basically stalled out trying to make new highs, and the net new highs had deteriorated from 109 down to 83. It's not a great picture. The S&P is currently the stronger index over the NASDAQ, but it looks vulnerable here. The leadership under the hood of the S&P is getting thinner and more narrow. So where is the leadership within the S&P? Well, ever since early December, when the Fed announced their plans for rates and tapering and inflation was no longer considered transitory, the S&P leadership, all of the defensive sectors have really taken off: consumer staples, healthcare, and real estate. They've all gone up strongly in the last month. Those are all defensive sectors. The cyclical sectors within the S&P, oil and gas, energy, the metals, and industrials, have all turned up dramatically even in the last couple of days, as this chart reflects some steep increases in oil and gas and energy. But you'll notice that they're still well off their highs. The materials is close to a new high, as well as the industrials. It's possible that these cyclical stocks might give us one last leg up in the S&P. So the current market analysis, let's look at the NASDAQ. This is a daily chart as of today. And we always want to look at the rallies and the action that we're seeing. So essentially in late December, we had a couple of point-wise, there were strong days. It was a 5-day rally in the NASDAQ with some good closes, but the volume attached to it was really, really mediocre. It was not very strong. And the NASDAQ started to pull back a little bit, back and fill. Today clearly was a distribution day. It was a wide range day. But on the positive side, there was support at the 50-day moving average. But you'll notice that this rally so far has not brought us up to the old highs at 16,212. So it's going to be a really interesting juncture to see if the NASDAQ can regroup and make a run at new highs, or we're going to get further deterioration. I marked a couple of lines in the chart. A 10% pullback correction would bring us down into the 13,500 level, and we could go as low as the October lows, which would be about 11.7% correction, and still be normal within a bull market. So we'll have to see how it plays out. The S&P is the stronger of the two indexes, and you'll notice that the 4-day rally in the S&P, where it actually hit new highs, again, the volume has really fallen off. It's kind of mediocre at best. The index kind of went sideways a couple of times, a couple of days. You'll notice that today it really tried to go into new high ground, and the volume picked up and we backed off. We had a stalling situation where the market could not close into new high ground. So the S&P is experiencing a little bit of trouble, which is not that surprising given the index is becoming more narrow. A correction on the S&P back down to the lows from early December would be about a 6.7% correction, and the October lows would bring us down about 11% off the highs. So I wanted to also show a little longer term chart for the S&P 500. This is a weekly chart, and what we're trying to just show here is that, you know, since the COVID bear market, the S&P 500 has made a 117% move in 21 months, a significant bull market. You'll notice, though, in the last month, we've had two big high volume distribution weeks on the way up. The other thing I would note is looking ahead, you know, the S&P is approaching the 5,000 level. That's a round number, kind of a psychological number that sometimes can form market tops. Just psychologically as it approaches that, whether it's 4,900 or 5,100, it's something to just to keep an eye on. It's about a 5% move from where we currently are. So as I mentioned, the cyclicals, the financials, some of these defensive names within the index, they may lead the S&P higher, you know, for another 4, 5, 6%. I would want to really pay attention to this 5,000 level if we approach it, to see how the index acts around that level, if it gets support or if it gets turned away. As I mentioned, in general, there's been rotation into cyclicals, and the leadership even within the S&P has been getting more and more narrow. So that's a lot to cover, but I hope you got something out of it today. I want to wish everyone a happy and prosperous new year in 2022. I look forward to talking to you soon again, and you can always find us at the Boston IBD meetup. Thanks again. We'll talk soon.